All right, let's talk about something that seems simple but is anything but. You look at a huge company, you see all their buildings, their factories, their equipment, but how do you know what any of that is really worth? It's a question at the very heart of business, and the answer? Well, it's way more complicated than you might think.
I mean, how much is a company's stuff really worth? Seems like a question with a straightforward answer, right? Well, it turns out this one little question has kicked off one of the biggest, most fundamental debates in the entire world of accounting. It really gets at the heart of how we even measure value.
Okay, so the simple, kind of common sense answer is, well, it's worth what you paid for it. Makes sense. You buy a delivery van for, say, 30 grand, then that's what goes on the books. And this super intuitive idea, it's actually the foundation of a major accounting principle.
And in the world of accounting, this has a name: historical cost. For ages, this has been the bedrock of financial reporting. Why? Because it's simple, it's clean, it's a record of something that actually happened, a fact set in stone. But, and there's always a but, that solid foundation starts to get a little shaky when the real world gets involved.
Yeah, this is where it really gets interesting, because the biggest enemy of that nice, simple historical cost is just time. Time passes, prices change, inflation kicks in, new technology comes along, and suddenly that old number doesn't look so solid anymore.
But you can totally see the appeal, right? I mean, historical cost is objective. It's straightforward and, crucially, it's reliable. You can literally pull out the original invoice and say, see, this is what we paid. There's no guesswork, it's a hard fact.
The problem is that rock-solid number from the past can become, well, kind of useless. Think about it. What happens when inflation goes crazy? Or what if a company owns a piece of land they bought for a song 50 years ago and now it's prime real estate? Does that original price tag really tell you anything meaningful today? All of a sudden, that reliable number starts to create some major distortions. The value of assets on the books can be just wildly out of sync with what they're actually worth in the real world. And this isn't just an academic problem. It can make profits look way bigger than they are, and it makes it nearly impossible to figure out if a company is actually doing a good job with the stuff it owns.
So, because of all these issues, accountants basically went on a quest to find a better way, a more relevant way to measure value, something that reflects what's happening today, not what happened on some receipt from years ago. And that quest led them to some really interesting alternatives.
And this is where the whole picture gets a lot richer. See, it turns out there isn't just one way to value something. Besides the classic, what did you pay for it? You could ask, okay, but what could I sell it for right now? Or what would it cost me to buy a new one? Or, and this is a big one, how much money is this thing actually going to make for me down the road? 4 totally different questions, and you guessed it, 4 very, very different answers.
So to really see how different these answers can be, let's take a look at a real-world example. Let's just focus on one single asset, a machine that a company bought 4 years ago for $100,000. We're going to value this one machine using all these different methods and just watch what happens to the number.
Okay, first up, the old standby, historical cost. The company paid 100 grand. After 4 years of depreciation, its value on the books is a nice, clean $60,000. Simple, verifiable. That's our baseline.
But what if they just wanted to sell it today? Well, after you factor in the costs of getting it out of there, they'd only get $45,000 for it. That's its net realizable value. Whoa, already 15 grand less than what the books say.
Okay, now let's flip it. What if they needed to replace the machine? A shiny new one costs more these days, of course. So adjusted for the 4 years of use on the old one, the replacement cost is $66,000. And hey, look at that. Now we're actually higher than the original historical cost.
And last but not least, we have the most forward-looking approach, economic value. This is all about the future. Based on all the cash this machine is expected to pump out over the rest of its life, its value is calculated at, get this, a staggering $95,755.
So there you have it. That is the central conflict in a nutshell. For the exact same machine, we have 4 totally different officially recognized values. They range from $45,000 all the way up to almost $96,000. That is a $50,000 gap. So, which one's the right one?
And you see, this isn't just a math problem anymore. It's really a philosophical debate. It forces us to step back and ask, what is the point of financial statements anyway? Is it to record the past with a 100% certainty? Or is it to give us the most relevant possible estimate of where things stand right now?
And that's the core trade-off, right there on the screen. Historical cost, it gives you something objective and reliable. The downside, it can be totally irrelevant for making smart decisions today. On the other hand,
Current value is way more relevant, but it's built on estimates and judgments. That makes it subjective and a whole lot harder to prove.
So when it all boils down, you're left with this fundamental tension. For anyone trying to figure out if a company is healthy, it's this constant battle. You're choosing between a number that might be precisely wrong and one that is only vaguely right. That choice between reliability and relevance is something every single investor has to think about.
So why does any of this matter so much? Well, because if a company sticks only to historical costs while living in a world of constantly changing prices, it becomes almost impossible for anyone, investors, managers, even you and me, to get a clear, true picture of how that company is really doing.
Look, the key takeaway here isn't to memorize which method is the best one. The point is just knowing that this debate is even happening. Because now, when you look at a company's financial report, you can ask smarter questions. You can ask yourself, okay, are these numbers based on a 10-year-old receipt? Or are they trying to tell me what this stuff is worth today? Just understanding that choice, that's everything.
And that really leaves us with that final critical question. When you're trying to figure out what a company is worth, do you trust the certainty of the past or do you go with the best guess about the present? There's no easy answer here. And honestly, that's kind of the point. A company's real value is hiding somewhere in that gap between the hard facts of its history and the messy, complex estimates of its future. The real skill is learning how to read both.